Hello, listeners. Welcome to the Morning Market Update, the podcast powered by AI. I'm Joe.
And I'm Sarah. Today is February 18th, 2026. Let's dive in. We are starting with a very active morning in the U.S. markets. Currently, we're seeing a bit of a tug-of-war on Wall Street. The tech-heavy Nasdaq is showing some resilience today as AI jitters seem to be evolving into a buy-the-dip mentality. While some software stocks have been hammered recently by fears that generative AI might replace traditional software tools, Citadel Securities is reporting that retail investors are jumping in at a record pace. The S&P 500 and the Dow are also looking for direction after a batch of strong economic data showed the U.S. economy is holding up remarkably well, what some are calling a boom session environment. However, it's not all green on the screen. The Russell 2000 is sensitive to the credit stress being whispered about in the crypto markets, and we're seeing some localized pain. Palo Alto Networks is a major loser this morning, with shares sinking 7% after their CEO defended a massive $25 billion acquisition of CyberArk. It seems the market is questioning these high-priced pivots into AI.
Moving north to the TSX in Canada, we're seeing a very different narrative play out, primarily driven by the massive surge in energy prices. With oil jumping 3 to 4% this morning, the Canadian index is getting a significant lift. As many of you know, the TSX is heavily weighted toward energy and materials, so when crude moves, Toronto moves. We're seeing big names like Suncor and Enbridge catch a bid as traders react to the breakdown of peace talks in Geneva and the rising tensions between the U.S. and Iran. Beyond energy, the Canadian market is also watching the shipping sector. Genco Shipping reported unseasonably strong dry bulk market activity. For those unfamiliar, dry bulk refers to ships carrying raw staples like iron or grain. If that's moving, it usually means global industrial demand is stickier than people think. However, it's a cautious rally. The fear and confusion mentioned by small business leaders in the region is palpable as they navigate these sudden commodity spikes.
Looking across the oceans, European markets are actually the star of the show today. The FTSE in London, the DAX in Germany, and the CAC 40 in France have all rallied to fresh record highs. It's a fascinating rotation. Traders seem to be moving capital out of overextended U.S. tech and into European value plays. Strong earnings reports across the continent are giving investors the confidence to ignore some of the geopolitical noise. Over in Asia, the Nikkei remains in focus after a landmark deal where Japan pledged $36 billion to U.S. energy and mineral projects. In India, the Nifty 50 is being highlighted by HSBC as a key area of value in the emerging market space. But we have to talk about commodities. Oil is the headline here. Brent crude is trading near $69 and WTI is over $64. This volatility is a double-edged sword. It's great for the producers but a massive headache for the Eurozone, especially as Italy moves to strip carbon costs from power bills to protect consumers. In currencies, we're seeing African issuers like the Ivory Coast successfully tap the Eurobond market for $1.3 billion, signaling that there is still plenty of risk-on appetite globally despite the headlines.
Let's get into the major North American corporate stories. First up, the IPO market is showing signs of life. While some firms like Clear Street have postponed their debuts, Solve Energy just successfully raised $513 million. It's a bright spot in what has been a turbulent year for new listings. In the tech space, Amazon is trying to break a recent losing streak, while Berkshire Hathaway's latest positions are being parsed by every analyst on the street. We're also seeing an activist play in the crypto mining sector. Starboard is urging Riot platforms to pivot their data centers toward AI processing rather than just Bitcoin mining. Speaking of Bitcoin, it's been a rough ride. It's down about 46% from its record high of $126,000 setback in October. Arthur Hayes is calling Bitcoin a fiat liquidity fire alarm, suggesting that the current price struggles might be a precursor to a wider credit crisis if AI-driven job losses start hitting the banking sector. It's a sobering thought for an S&P 500 that has been so reliant on the AI narrative.
Now, let's look at the international business scene. In Germany, Bayer is making headlines, but for the wrong reasons. Shares fell 7% after they proposed a $7.25 billion settlement in the long-running Roundup case. Even with the European indices hitting records, Bayer is a reminder of the lingering legal risks in the chemical sector. In the energy world, we're seeing a major shift in Libya. They've awarded fuel supply deals to Western giants like Vitol, Trafigura, and Total Energies. This is a strategic move to cut off Russian fuel imports and reboot their local energy infrastructure after years of instability. Also, the New York Stock Exchange chief made an interesting comment today, noting that what happens on prediction platforms, where people bet on outcomes like elections, is increasingly steering traditional markets. It's a new frontier for finance. Finally, in Japan, that $36 billion investment pledge we mentioned earlier is being seen as a first tranche of a much larger trade deal with the U.S., which could redefine energy security for the Pacific Rim for the next decade.
Turning to the big picture, the intersection of economics and geopolitics is particularly messy today. On the policy front, we have a major spat between the White House and the Federal Reserve. NEC Director Hassett slammed a New York Fed study on tariffs, calling it the worst paper he's ever seen and suggesting the authors be disciplined. This kind of public friction between the administration and the central bank researchers is rare and creates uncertainty about future trade policy. Meanwhile, the geopolitical risk premium is back in oil prices. Vice President Vance indicated that Iran has ignored key U.S. demands and military strikes are now openly being discussed. This, combined with the collapse of the Russia-Ukraine talks in Geneva after only 2 hours, has ended the hope for a peace dividend in the markets. We are back to a war footing in the energy markets, and that is going to keep inflation on the Fed's radar for the foreseeable future.
To wrap things up, here are the key takeaways for your trading day. First, Europe is currently the safe harbor for growth, hitting records while the US and Asia deal with more direct geopolitical fallout. Second, oil is back in the driver's seat. The 4% jump this morning will likely weigh on transport and manufacturing stocks while boosting the TSX and US energy names. Third, the AI narrative is changing. We're moving past the hype phase into the inflection point where we see actual winners and losers in the software and job markets. And finally, keep an eye on Bitcoin. If Arthur Hayes is right and it's a liquidity fire alarm, the current slump might be telling us something about the health of the global credit system that the equity markets haven't priced in yet.
That wraps up today's update. I hope you gained useful insights into the shifting dynamics of the global markets.
Add your thoughts in the comments and follow for more such updates. This is Sarah.
And Joe, signing off.